So before we get into the segment, we really want to look at, what are Brent prices doing? And one of the things that we had said is that when we broke through, because remember at 96, everyone's like, oh, we're going from 96 to 105. And we're like, well, the physical market is not really showing that we're going to 105. If anything, it says we should go a bit lower. Then you had that big move down from 96, crashing through 88, which was kind of that softer floor, to the harder floor of 82, 83, but really that 83, 84 level. Our view was that at that 83, 84, the next move wasn't to 80, but to 90. So now we've come back up to 90, and now we're playing with some geopolitical premium here. The market is back up given the commentary out of Iran about a potential embargo. In segment one, we talked about how that wouldn't have the impact, nor I think the political will to do it, given how intertwined the U.S. is within the Middle East versus where it was in 1973. And plus, obviously, we're on a very different footprint on a military basis as well. But when you start looking at the issues, obviously Gaza, Iran, as we went through in last week's Israel-Gaza show, we talked about, there's a lot of pinch points in this. When you look at the Strait of Hormuz, when you look at the Red Sea, when coming around Yemen, when you look at the Yemen with the Houthis, and when you look at the Suez Canal, there's a lot of uncertainties. So when you start looking at the backdrop of where we are, we assume that there's probably about $5 to $7 sitting in geopolitical premium. And the likelihood of us kind of staying between this 90, 92 level is very likely, given a lot of the rhetoric. We saw a lot of accusations fly from both Israel and Hamas about the hospital. We've seen, I think, of a much clearer direction of where that was in terms of a misfired rocket that struck not the courtyard where unfortunately a lot of people were staying at the time. So there's a lot of things that we want to look at. We'll talk more about that in segment in the Econ show. But we want to look at, the hard and fast numbers when we start looking at OPEC decisions. So here, when we start looking at the outlook, there's a growing view of a surplus in 2024. And while some of that is being driven based on an increase in supply, it's also, and in our opinion, for those that have been following us, it's that demand gets worse. And that's where we continue to see that kind of playing out over the near term when you look at the balancing act. So OPEC is still showing a shortage in 2024. But if you look at the IEA, they're now showing that we're going to go from a deficit to a fairly sizable surplus. And a lot of that is from OPEC crude, but as well as on a demand side of the equation. And then when you look at the EIA, showing something a bit more balanced. Now, obviously, you finger to the wind on what is Q3 2024 demand going to look like. But one of the things that we've tried to really drive home is that inflation's not going anywhere. It remains sticky. You now have more and more concern. And typically when there's geopolitical unrest like this, are you willing to go travel? Do you want to get on a plane? Do you want to go to a foreign land? And that, people start to tighten back up. It doesn't mean that you won't travel within your own vicinity that you at least feel comfortable with, but it limits the amount that you normally do. So that's from a geopolitical perspective, but then also from just the underlying economics where the consumer's not in a good spot. As we've been saying, it's not that the U.S. is going to dip into this massive recession. It's just a bigger slowdown. We've said from the beginning, China expectations on China were way too strong. We by no means ever said it was going to be a recession, just that expectations were well over their skis. And we've seen that time and time again. And we laid that out in last week's Econ show, as we will again in this week's. So then when you start looking at crude supply coming out of OPEC, you've started to see it bleed a little bit higher. And, when you look at Saudi Arabia, small little bounce. When you look at Iraq, something similar. So realistically, you had about 300,000 additional coming from OPEC. You had about 200,000 coming additional from non-OPEC nations. But realistically, Iran will come down a bit given the fact that there's going to be renewed pressure on them. We do expect flows going from about exports of 1.5 to 800,000. But for those that have been following us on both Twitter, based on insights, we've been saying that if things increase against Iran, watch Venezuela. If Venezuela is in a quote unquote easy place for the U.S. to go and lift sanctions, give people a different waivers, and there's about 500,000 barrels that can come fairly quickly from Venezuela. So overall, we've seen some of that stabilization and some of those movements up in crude production. But if demand is really going to become that problematic in 24, do you start to see them take action? Now, my short answer is no. They've already said that they're going to keep things the way that they are. Saudi's keeping the additional 1 million barrels off the market through the end of the year. But if 24 is shaping up the way that some of these expectations are, there could be a chance to take some more off the market. But the Saudi also has to contend with, well, are we giving up too much? They've given market share to some of these entities. Do they really want to continue to take the lion's share of the pain to keep prices where they are? Because let's be fair, if not, and again, not to say it's going to happen, but if Israel-Gaza starts to cool off a bit, not that we think it will, we do believe that there is going to be Israel moving into Gaza, likely not going to stop till it reaches the coast. That is going to be a bit more risk premium coming in. So these are going to be some important things to contend with when you look at trying to plan, which is why looking further down the curve, I think, makes a bit more sense. Then when you look at the shrinking profits, this is a problem. When you look at, how are refiners making money, it's diesel still a moneymaker. Gasoline is not. And so how do you contend with, there's a shortage in the market because what Saudi took off the market is that heavy medium barrel, which is what Venezuela can bring back on. Iraq has been taking advantage of that, selling more of their crude because they do have that medium heavy grade. But again, this is why you're going to continue to see these movements lower. And if diesel softens in the slightest, again, it's going to put more pressure on refiners and could result in those economic run cuts. So then when we start looking at underlying flows, it's always important to kind of weigh where things are. So when we look at crude flows, you can see that Saudi had a sizable drop, but they've been staying at a bit higher end versus where they are. It's all about timing. But then if you look at Iraq, which is that blue, you can see bouncing right back to the top, where the UAE, excuse me, and Kuwait are a bit of that timing side. But are we seeing more products go out while we're seeing some of these crude flows diminish? And it's something where Iraq is likely going to stay at a much higher level. Then when you look at Russia, Russia has seen a bit of an increase in total flows. You can see that there was a nice little spike. It started to come down a bit, but given that back and forth in terms of trying to manage the refining side, we do expect to see some of these crude volumes increase slightly. Again, not a huge amount. It's not going to go back to the levels it was in 2023, but we also don't see them maintaining as close to as they have to the agreement that OPEC has. And then does that mean that then Saudi gets annoyed at the fact that Russia is bleeding more barrels into the market, and they will likely, again, cross at a discount? So then when we start looking at Brazil, because there's multiple countries out there that are moving volumes, and it's important to look at how much crude Brazil is putting into the market. They've had some additional production come online. So it's not that we have to weigh where are the barrels coming from. You can see that there's almost been 1 million additional barrels coming to the market per day when you look at the amount of volume, and this is a good thing. But the question is, where is it sailing to? Is it going to Asia or really the Asian markets? Is there a chance that it's going to come more into the U.S.? But this is not something to sleep on, and ways to kind of counterbalance some of those levels, which is why we still don't see crude going to 96 or really 105, but really kind of hanging in to a much tighter range as different entities kind of weigh those levels of geopolitical risk. We are at the lowest point of demand in terms of seasonality. This is when we have the most refinery turnarounds. So it's going to be important to weigh some of those different aspects when we look at total underlying pricing. Then when you look at flows, you can see that China continues to export a significant amount of product, well above what has been in the past. India, something similar. This is an important piece because, yes, China has increased refinery runs, but they've also increased exports. They're not increasing runs because demand is so strong internally. It's because, there's a great market out there, and China has built a significant amount of refiners. So runs have to increase because if you've spent billions and billions of dollars on building an asset and a facility, you're going to turn it on. So again, that's why it's important when you start weighing, the processing capacity of China. There's been a lot of new refiners that have started to turn on as we got into 22 and then continued into 23. But that's why we've talked about overall, there's a lot of refining capacity in the market. It's all being built away from North America, away from Europe. So even though everybody says, we need to get away from refined products, it's like, or fossil fuels, we haven't yet. And all of the options aren't all that great. So we still are beholden to diesel and gasoline, and we're relying on others more and more to provide it, which is why, one of the things that we're investing in at C6, renewable diesel, using biomass, renewable forestry and forestry waste, as well as ag waste, because it's like, look, we have to find other solutions to make sure we can maintain a certain amount of energy independence away from the floating market and that increase in competition. Then when we look at gasoline in exports and distillate exports, you can see that it's still remaining fairly elevated from the Saudi and the UAE, but you can see that bigger drop in Kuwait. So again, there hasn't been too much of a shift, but this is going to be an important one to watch as we look at the East versus West Suez. And then when you look at Russia, you can see that there's still a sizable drop in what has been exported. And a lot of that is because of the ban. So, excuse me, we've seen some additional products come back to the market just because the ban has been softened. It's still in place, but again, this is going to be an important piece to watch because as they remove the market, stay out of the market, other products will have to come in, and it's just going to be a matter of who's filling that gap. Can they fill the gap, and what is that going to look like over the next few months? So then when we look at the Middle East floating storage has trended a bit lower. We do see that against kind of stabilizing here. Historically speaking, we do get a bit of an increase, and a lot of that is seasonality. But then it comes to, do you really want to risk some of these cargoes sitting in the water given the uncertainty in the region? Could the Houthis strike it? Is it something where the Iranians could try to disrupt? So we do expect to see this remaining a bit tighter as people, and let's be fair, insurance is expensive and freight rates are expensive. So you're not going to be in any hurry, especially in this region, to keep barrels on the water. Then when you look at flows coming from the U.S., we're still maintaining about 4.3 million barrels a day of exports. We likely see that stay here, which is something that is going to remain very supportive of those flows. Now, when we start looking at some of the different pricing scenarios, when you look at the underlying diesel markets, here you can see that the diesel markets are still remaining fairly strong in Asia at about $26.79. We see it holding above 20. We saw that nice dip, but again, between that 25 and 30 level is going to be supported given the flows, given the backdrop in the Asian markets. When you look at, Brent is still much cheaper than Dubai, back to the commentary that we made about, risks and just inherent costs. Dubai has to go through those exports from the UAE have to go through the Strait of Hormuz. That's going to create, again, additional struggle, additional concern when it comes to not only insurance, but also, the availability. Asian floating storage coming down a bit. We do see this bouncing back up closer to, as we said, between 2022 and 2021 numbers. It's just going to be a timing delay. We've seen some increase in buying, especially when you look at the increase in buying here. We're back above where we were in 22, and buying still remains fairly strong given some of the activities within the region. But it's interesting because even though you're seeing an increase in activity of refiners in China, it's not the teapots or Shandong refiners, it's more state-owned assets. And this is going to be that continuous conflict because, as we've been saying, as the SOEs come on, it's going to be at the expense of the Shandong refiners, and you're seeing that hit here. So we do see some increase, but it's going to be difficult given the amount of new production and new activity coming on from the SOE front. When you look at traffic, traffic bounced, but it was pretty much in 2022 lines, which is actually concerning, just because we did have 4% more than last year travel. I should say, no, I think it was 27% more than last year travel for Golden Week, 4% more than 2019, but spending was only 1.7% better. So these are things that we outlined in last week's China show or Asia show. And this is a concern because the comps are getting easier, especially in 22, because we had an increase. Obviously, it's getting closer to winter. You had an increase in COVID. You had more lockdowns. So China should be outperforming 2022 levels, and it really isn't to a meaningful degree, highlighting that things aren't terrible, but they're also much below what some of the issues are in general in overall. So then when we start looking at West Africa crude, you can see that floating storage has increased massively. You can see that there's overall a lot of this is Nigerian. It's sitting at a much higher level. It's actually touching or getting close to the all-time high, and actually taking out the highs that were achieved in March. So this is the concern that we're talking about: is what does Nigeria do to move these barrels ahead of December's announcements? When we turn to the U.S., you can see that distillate had a big drop of 630,000 barrels a day. We see that staying below the 5-year. Gasoline is going to trend a bit lower, but still remain stronger. Propylene had a bigger dip, but a lot of that is timing because you had a lot of crude exports. So, it's usually at the sacrifice of other things. And here's where we can see. So we do see that balancing out just a bit. When we look at gasoline exports, it's going to trend a bit lower, still remain above the 5-year average because they're still looking to send this to places to, again, get rid of and balance their position, because a lot of these refiners are trying to target and create as much distillate as possible, and they're pushing this into Latin America for the most part. But here you can see that a bit of an overaction to the downside, but it holds to the fact that distillate exports are going to stay below the 5-year average. It still makes more sense and is cheaper and more profitable to sell it internally within the U.S., given the backdrop on the distillate market. Crude oil exports staying strong. We don't see that changing. Propylene, when you look at total flows, you can see that propylene has come down, but again, we still see this remaining well above the 5-year average and likely staying in that top level. When you look at ethane exports, again, staying strong, seasonally adjusted all-time high, seasonally adjusted highs. We still see this at a record-setting pace. When you look at Fujairah, light distillate continues to remain elevated. Total stocks came in at 18.509, which was a total drop of 1.257. Light distillates had a fall of 358,000 barrels to 5.467. But again, that's still well above where we were when the last time we looked at this, because it was closer to 4. And it's again, we've seen some demand in general for gasoline, but gasoline prices were slightly supported by some buying from Australia. But overall, we see more and more gasoline being moved into the market, which will keep those numbers lower. On the other hand, middle distillate had dropped 863,000 barrels, big drop to 1.631 million. East of Suez gas oil market was seen steady and slightly better, with some traders saying that emerging spot demand from Southeast Asia buyers had lent to some of the support. Gas oil market isn't terrible, but it's more of the East Suez side, because that's where they're seeing the benefit going through, which is leaving short some of the West Suez. And then, as I mentioned earlier, South Korea is going to support some of the subsidies in the motor fuels, especially the gas oil market. And then obviously Israel, Hamas continues to support things in terms of pricing. So again, middle distillate's going to remain tight. Heavy resid dropped 36,000 barrels. Spot trading at both hubs of Singapore and Fujairah is fairly flat. We don't see too much getting better given the limitation. And when we look at the bunkering hub, ship fuels dropped to a 3-month low. And again, the comps are not great. So it dropped to a 3-year low just shows more and more pressure on the market in general. Backwardation remains elevated in Brent. We see it drifting a bit lower, but again, staying elevated just given the underlying market when you start looking at the pressure points and the geopolitical risk. Then when we look at flows, as we were saying before, Nigeria is increasing production and slated exports for November. So the fact that they're increasing exports for November, they haven't been able to sell barely anything in November, is going to put even more weight on December, while the other regions continue to see a fairly leveled amount of crude in the export market. So Nigeria is going to continue to be that overhang. Then when we look at Europe, you can see that there was that nice bounce, which typically happens from the lows. We do see that continuing to trend higher, and that comes in line with that slowdown in demand driven based on the amount of refiners in turnaround. But the bigger issue is, what is the available crude, and are they going to get that availability of crude going forward? So then when we look at the total amount of product, you can see gas oil had a small drop. When you look at naphtha and some of these others, something similar. So here you can see that there was a bit of a drop. So overall, it's still in a very tight spot. It's slightly better than it was in 2022, but again, not a huge benefit in general. So we still see more pressure on the gas oil front. Gasoline, seasonally adjusted all-time highs. It's above where we were in 2022 and 2020. Until they start to export more, you're going to see this be the problem. And given just the slowdown in demand in Europe, more of a seasonal level, you're going to continue to see the pressure to the downside. Fuel oil, again, being on the higher side, they'll likely try to reuse some of this in the recracking or cracking side, because the ability to get this into East Suez continues to be closed, especially given the amount of heavy resid and heavy disti that is sloshing around in the market coming from both Russia as well as the Middle East. Then when we look at stockpiles in Singapore, you had a pretty sizable drop, but it's going to be important of what caused it. So light distillate coming back down. It's still the third highest it's ever been. It's below where it was in 2020 and 2022, but above where it's been otherwise. Seasonally speaking, which is why, back to my comments in Fujairah, even though you saw that drop in gasoline, that it's supposed to happen because there are parts of obviously the Eastern Hemisphere. Excuse me, when you look at they're going into their summer months, so you get that summer demand. So this is still much higher, and we don't see this getting much better. And this will keep pressure on the light distillate gasoline market. Middle distillate, getting a bit better, which is why we saw a bit more pressure on the middle distillate crack in Asia versus the U.S. And a lot of this is because China and India continues to export a significant amount, which is going to actually make their storage get a bit better, which should start to kind of pivot some of those Middle Eastern cargoes into the Atlantic Basin. We just haven't seen it yet. That's going to take time, and we should see that increase as we go into November and December as more pricing pulls things in. And then when you look at heavy resid, it's going to bounce around. We do see this bouncing back up. Then when we turn to North Sea, storage remains flat because there is so much demand for a lot of those flows. And then, so when we look at North Sea, still remaining at the low end to no floating storage. And then when you look at Europe moving to this lower side because there is more demand or ability to pull this onto the land side. So we don't see this improving and staying at the lower end. So that's what we have for you on the EIA show. If you have any questions, please let us know. And hopefully we will see you next week. Thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.